Today we're going to start chapter 15, which is part of unit 6, and it is going to be focusing on financing the enterprise. And again, even if that is not your area of expertise, it's something you need to be familiar with so that if you do venture out on your own, you will have a little bit of a background about financing, how you would take care of that. So let's begin talking about money in the finance system. Uh, Whether it's Wall Street or to Main Street in Canton, both overseas and at home, money is going to be the one tool that is used to measure your personal and your business income and wealth. Finance is the study of money, and you're going to get into that in some other classes that you'll be taking. So this area is going to be very simple. How it's made, how it's lost, and how it's managed are what we're going to be looking at. This chapter is going to introduce you to the role of money and the financial system in the economy. If we define money or currency, it's anything generally accepted in exchange for goods and services. Materials can be something as simple as salt, cattle, fish, rocks, cloth, as well as precious metals that could be gold, silver, copper. And those have all been used in various cultures as money. While paper money was first used in North America in around 1865, the concept of what is called fiat money or paper money was not readily convertible to precious metal or gold, and it didn't gain full acceptance until the Great Depression in the 1930s. In the 1930s, the United States paper money was a government note or a promise that was worth a value, a specific amount that would be converted for the note. The functions of money as a measure of value. Money is going to serve as a common basis of the value of what our goods and services is. Money is going to be your common denominator that will allow people to compare different goods and services that could be consumed on a particular income. We are all going to use money as a measure of the value of our earnings, our purchases, or what we own. Money is going to serve as a way to accumulate wealth or even your buying power. It's also a store of value because we can accumulate it until we need to use it. Due to rapid inflation, a lot of prices double in 1 year, and then the purchasing power value of money stuffed in the mattress would fall by 1/2. So what this is trying to tell you is don't hide your money, don't put it in a mattress. On the other hand, deflation occurs when the price of goods fall. Remember we learned about inflation and deflation in another chapter. Deflation might seem to you like a good thing for consumers, but in a way it can be just as problematic as inflation. Periods of major deflation often will lead to the decreases in wages and then again increase in debt burdens. You probably have not thought about money having characteristics, but it does. And these are some of the things that we know that in order for money to be used as a medium of exchange, it has to have these characteristics. Acceptability is to be effective. Money must be readily acceptable for the purchase of goods and services or for the settlement of debt. It has to be divisibility, and it says, given the widespread use of quarters, dimes, nickels, and pennies in the United States, it is no surprise that the principle of divisibility is an important one. What that means is I can take $1, I can buy a 25-cent candy bar. Yeah, right. I know, when have we bought a 25-cent candy bar? And I can get my change back in coins. It has to be portability, meaning that money has to be easily moved from one location to the next. It has to have stability. It has to be stable and maintain its declared face value. It has to be durable. Money has to be durability. And it has to be difficult to counterfeit, so that people don't just go out in their basement and start making money. Um, the U.S. government will redesign currency very rapidly in order to stay ahead of counterfeits and to protect the public. Did you know that around 75% of counterfeit currency is found and destroyed before it ever reaches the public? But if you have ever gotten a counterfeit bill, you think, how did this happen? Now, most of your stores, if you'll go into a store, I don't care if it's a $10 bill or a $20 bill, they have that pin and they go across it just to make sure that it is not a counterfeit bill. The next slide is going to be talking about the 4 types of money. We're not going to be looking at all 4 of them, but it's a cute video and I thought you would enjoy it. So the 3 types of money that we're going to talk about is paper money and coins, and they are the most visible types of money. The combined value of all printed bills and the coins is actually rather insignificant when we compare them to the value of money kept in checking accounts, savings account, or other monetary forms. Of course, you have a checking account. Now, one thing I want you to make sure you know is you know the difference between a checking account and a savings account. A checking account is considered a demand deposit, so that if you write me a check, I can also walk into the bank and I am demanding that you give me the money that is due for this checking account. A savings account is considered a time deposit, and it's usually accounts with funds that can't be withdrawn without advance notice, meaning I have to walk into the bank and I have to fill out a savings account withdrawal slip, and then they check to make sure that I have the money in there. So those are the 3 that we will be looking at this chapter. Some other kinds of money that we're going to be talking about are money market accounts and CDs. Money market accounts generally offer a little bit higher rates than standard bank rates, but they do have greater restrictions. It's just a way of it. You know, most checking accounts don't give you they don't pay you any interest. Money markets do, but at the time it's very low amount. You can also get CDs and our certificate of deposit. And what a certificate of deposit does is it's really a savings account that guarantees that you are going to have a specified interest rate for as long of the period as you bought the CD for. Most of them are generally 6 months to 1 year. I know I just actually bought one that was 18 months that was paying a great interest rate. So those are some things that you do get money, but you do have to abide by your banking industry or whoever you've got this with, their rules and regulations. And I know that most of you know what a credit card is. A credit card allows you to purchase things immediately and then pay for them to either 30 days or you put it out over a time. There's always a minimum monthly payment, and there's always interest that's charged on your remaining balance. Some people pay off their credit cards monthly, and that therefore they're not paying any interest rates, while others make monthly payments. Keep in mind that charges for unpaid balance can run minimum generally of 18% or higher. Um, that makes the credit card debt in the United States the most expensive way to borrow money. I know that on my credit card, I have a Citibank credit card, and of course I pay mine off every month. But I noticed I got a flyer in the mail the other day, and they were going from 18% up to 23%. And the reason that you're going to see this happen is because of the unpaid balances. People will put so much on their credit card that they can't pay it. They declare bankruptcy, and then your credit card company loses their money. So even though this isn't my personal finance class, I'm going to throw this out there to you. Stay away from credit cards if at all possible. Everybody needs a credit card, but you need one with a $500 limit that you can only have a $500, buy something no more than $500 a month. Pay it off as quickly as you possibly can. Now, something that is newer on the money market, the money accounts now are debit cards and near money. Debit cards are a credit card that looks a card that looks like a credit card, but it works exactly like a check. When you use a debit card, it's immediately taken out of your checking account and put into wherever it is you're using your debit card at. A debit card does help you keep track of your budget, because if it's not in your credit card or your checking account, you cannot get it. Near money is considered traveler's checks, money orders, cashier's checks, and what they are is it's not money, but it's guaranteed, just as if it was cash. And this is credit card fraud. More and more computer hackers have managed to steal credit card information from retail giants such as Target, and this is running into the billions. A lot of things is that if you look at your personal finance class, if you haven't taken that yet, if your debit card or your credit card is stolen, you are generally responsible for the first $50. And if you don't report it within, I believe it's 48 hours, then you are responsible up to $500. I actually had my debit card stolen, or I dropped it. I don't know what happened. I had it one day and it was gone the next. And someone used it in 3 different areas within my town of Canton. My bank, I was so happy that my bank kept a tight rein on this. Within an hour after seeing these charges come up in places that I didn't normally frequent, they actually shut my debit card down, called me and asked me if I had made these purchases. And when I looked on my online banking, I said no. So I was not held responsible for anything of that. So when you're looking at a bank, see what their this was a community bank. Make sure that you know what their policies are if your credit card is stolen. So let's talk a little bit about the American financial system. What is known as the guardian of the American financial system is the Federal Reserve Board, or you will hear people talking about the Fed, and it is commonly called that. It is an independent agency of the federal government. It was established in 1913 to regulate the nation's banking and financial industry. The Federal Reserve System is broken down into 12 regions with a Federal Reserve Bank that serves that defined area. So like the state of Georgia is under the the southern region with several other states, and we have our own Federal Reserve Board. Now, I'm not sure where it's located. I would assume it's probably in Atlanta. So the four major functions of the Federal Reserve System is one thing, it's going to control the money supply with monetary policies. They're going to regulate banks and other financial institutions. They're going to manage regional and national checking account procedures, or what is called check clearing. And then it's going to supervise the federal deposit insurance program of banks that belong to the Federal Reserve System. The Fed controls the amount of money that's going to be available in the economy through what is called monetary policies. Without this intervention, the supply of and demand of money might not balance. So then this could result in either a rapid price increase, which of course remember is what we consider inflation, because of too little money, or an economic recession, or a slowdown of price increase, which would be de-inflation, because of too little growth in the money supply. To effectively control the supply of money in the economy, the Fed must have a good idea of how much money is in circulation at any given time. This is becoming a challenge to them because of the global nature of our economies. What that means is that a lot of our money is circulating overseas, and they don't have oversight of that. So they have to use several different measures of the money supply that they've established specific growth targets, which is going to ensure a close balance between the money supply and the money demand. The next video is just a real quick video that gives you an overview of what the Federal Reserve System is.
Let's say the United States needs money. Instead of issuing their own United States notes backed by their own credit, they issue treasury bonds. They then sell these bonds to the Federal Reserve, which buys them with money they created out of thin air. The money that the Fed created then goes to the U.S. The U.S. then pays interest on the money that the Fed lent to the Treasury. So to clarify, the Fed creates money from nothing, loans that money to the U.S., and then charges interest on that money. What this means is that there is never and will never be enough money in circulation or in existence to pay back that debt. We as a country, as well as private citizens, are forever enslaved by debt with no way of ever paying it off. Now, when the Federal Reserve buys bonds on Wall Street, the major financial firms that have been selected as dealers deposit the proceeds at their own banks. Fed rules require banks to keep 10% of their deposits in reserves, but the bank is free to issue loans equal to the remaining 90%. Let's say the Federal Reserve buys a $1,000 bond. After putting away 10% into their reserves, they are then able to loan out 90%, or $900. Since the original $1,000 is still on deposit, the $900 in loan proceeds is more new money, money created out of nothing. A total of $1,900 of new money is now available in the economy. Now the person that took the $900 loan spends that money. The payee then deposits the $900 into their bank account, and once again, reserves and deposits increase. This process goes on and on until that original $1,000 bond, which was created from nothing, becomes $10,000, making this one full-fledged debt machine while also devaluing the dollar. The more money that is out in the economy, the more the value decreases. There's no wonder that since the implementation of the Federal Reserve in 1913, the dollar has lost over 95% of its value. The US dollar will eventually be destroyed due to an overwhelming financial crisis, and a globalist-run monetary authority will come along to save the day. And much like the Fed pretends that its goal is to prevent another Great Depression, the global currency will pledge to prevent another financial crisis, thus putting more power into the hands of a few and enslaving humanity that much more. 5%. That's the way of the U.S. government. I mean, just like Benjamin Franklin said, if you sacrifice your liberty for security, then you're a patriot. Or something like that. We didn't know, we never will.
One of the roles of the Federal Reserve is to use its policy to keep money flowing. Remember, money is the lifeblood of the economy. Very, very important that you remember this. This is what keeps our country floating, is money. If some banks become too protective of their funds and then they stop lending money to not only consumers but to businesses, it's going to cause the economy to come to a grinding halt. The Federal Reserve will fine-tune money growth by using 4 basic tools: open market operation, reserve requirements, what is considered the discount rate, and credit control. Generally, there's going to be a lag of 6 to 18 months before the effect of these charges shows up in the economy. Now, open market operations refers to the decisions to buy or sell U.S. Treasury bills. And U.S. Treasury bills are short-term debt issued by the U.S. government, and it's also called T-bills, and then other investments that are open in the open market. Notice that it tells us here that buying securities increase money and supply and vice versa. T-bills, to me, are a great investment because they're pretty secure, and if you are not an aggressive investor, that's something you might want to look into, is buying some T-bills. Now, the reserve requirement is the second one. The second major monetary tool, of course, is the reserve requirement. And what that is the percentage of deposit that banking institutions must hold in reserve. And it's in a vault, as if we were saying that it's there. And they are not available for lending to business consumers. It has a strong effect on the economy, and it's not used very often. The third monetary tool is the discount rate. Now, the discount rate is the interest rate that the federal government charges to loan money to banking institutions in order to meet that reserve requirement that we were telling you about in the last slide. Lowering discount rates also encourages borrowing and expands money supply, the money supply. The fourth one is the credit control, and they have the authority to establish and enforce credit rules for financial institutions and some private investors. This is just some ways that the tools that the Federal Reserve uses to regulate the money supply. They can buy government securities, and what that is, it's the money supply increases, then economic activity increases. They can also sell government securities. When the money supply decreases, then economic activities slow down. They can raise the discount rate, and that's the interest rate increase. The money supply decreases and economic activities slow down. They can also lower the discount rate, which means that the money supply increases and economic activity increases. I want to stop right here and talk about these two right here, because these are very important, not only in your personal life, but as if you are working in a business. Whenever the feds raise the interest rates, then you want to know that it's gonna, if they raise it, it's gonna increase how much how much interest is going to be on your credit cards, on home mortgages, cars. So that's something you always need to keep an eye on, especially if you're considering buying a new home. You definitely want to try it when the interest rates are lower. They also can increase the reserve requirements, which means banks make fewer loans, then the money supply is going to decline, and then economic activity is going to slow down. They can decrease it, which means the money supply is going to increase, economic activity is going to increase. They can relax credit controls, meaning they're going to encourage more major purchase, which is going to increase economic activity. And they can also restrict credit control, where they're they're discouraging people from making major purchases, and then it's going to decrease economic activity. Some of the other regulatory functions of the Federal Reserve is they regulate member banks. They establish and enforce banking rules that affect monetary policy and competition. And they also are the ones that will authorize to approve bank mergers. Banks cannot just gobble up other banks. It has to be approved by the Federal Reserve. They are also what is considered your check clearing, and it is the clearinghouse where every check goes through. So they know everything that's going on as they're, all the banks or all the checks that are written go through this clearinghouse. And then I think this is very important, is they provide depository insurance. And what they do is they supervise the federal insurance funds that protect the deposits of the members in banking institutions. Back in the early 2000s, when we went through the economic crunch, I think at that time they were only insured for $100,000 per account that you had money in, but now it is up to, I think, $250,000. So if you have your money in a federal bank, then they can actually guarantee that if that bank closes down, that your money is protected. The next couple of slides all have one thing in common, and it is that they are the businesses whose objective is to earn money. They manage, they're going to safeguard, they lend money to others. Their revenue is going to come from the fees and interest that they charge for providing these financial services. Now, the first one we're going to talk about is commercial banks, and commercial banks are your largest and oldest financial institutions. They generally are going to do checking and savings accounts. They are also funds, they also have the funds to loan for businesses and individuals. The next one is the savings and loans associations, and they're often called thrifts. And what they do is they primarily offer savings account and make long-term loans for residential mortgages that, again, are called thrift. Many of these have actually merged with commercial banks, and so you don't see very many of these anymore. The next couple are, first of all, a credit union. And a credit union, again, is a financial institution, but it differs from a bank is that it is controlled and owned by the depositors. Who usually have a common employer, profession, trade group, or even some religion. 10, 15 years ago, credit unions were solely operated within a profession or a trade group, something like that. But now, just about anybody can go in and join a credit union. They do charge you a fee to join. But one of the things that you want to think about if you're looking for borrowing money is to use a credit union, because generally their interest rates are a little bit lower on payback for loans, and then again it can be a little bit higher if you are, say, putting money in a credit union. The next one, of course, is a mutual savings bank, and they're very similar to savings and loan associations, but like credit unions, they are owned by the people that deposit money in them. They are among the oldest financial institution in the United States, and they were really established to provide a safe place for savings of particular groups of people, such as fishermen and firemen and things like that. They are found generally in New England, but they are beginning to become more popular in other areas.
Between a bank and a credit union? Well, that's a lot like asking the difference between a turkey and a chicken, or turnips and parsnips, or Cool Whip and whipped cream. All of which, if you ate together, would be disgusting. Please tell me you're not doing that. Anyway, now it's true that banks and credit unions provide a similar array of financial services like savings and checking accounts, mortgages, loans, things like that. But if we delve a little deeper, we can see that credit unions are decidedly different. Unlike banks, credit unions are cooperatives, which means they are member-owned. So you don't need to have deep pockets to feel like you own the place, because you already do, and anybody can join. With equal vote, equal share, and equal say for every member, credit unions could put more earnings back in your pockets by offering better member benefits, such as affordable loans or low-fee accounts. Now, one of the major benefits of credit unions are their ding-free ATM network. Now, that means that any member can walk into a credit union ATM, not into, but to, can't walk into the ATM, unless you have your eyes closed. Anyway, you can walk up to the ATM as a member and take money out and not be hit with surcharges. That's awesome. Another thing is, all decisions made by credit unions are made locally, as opposed to in another province or even in another country. Credit unions are also dedicated to helping the community that they're a part of through donations, sponsorships, and volunteer work. And with dedication like that, it's no wonder that credit unions are getting some of the top rankings and a lot of awards for their customer service. So, now that we know more about the differences between banks and credit unions, we can go back to some of those other things.
So let's talk a little bit about the Federal Deposit Insurance Corporation, or it is known as the FDIC. It insures individual bank accounts. It was established in 1933 to help bank failures throughout the country during the Great Depression. Today, the FDI insures your personal accounts up to a maximum of $250,000 at nearly 8,000 FDIC member institutions. The National Credit Union Administration regulates and charters credit unions, and again ensures that they insure their deposits through that National Credit Union Insurance Fund. Up to this point, we have been examining banks and credit unions as the major financial institution within the United States. But there are other firms that provide financial services, loans, or some of the other bank-like products. Non-banking institutions that perform services can include insurance companies, large pension funds, mutual funds, brokerage firms, and finance companies. There are funds that help the customers finance the purchase of expensive equipment. Automobile companies such as Ford and GM, what they do is they finance when you buy a new car, a new truck, or something like that. Insurance companies, they actually finance insurance that protect your products for a certain amount called a premium. You also have pension funds that are managed investment pools where there's money set aside by you as a individual or corporation or a union or even nonprofit organizations, and they provide retirement income for members. One type of a pension fund that we have talked about previously is called an individual retirement account, or an IRA. And it is established by individuals in order to provide for their retirement account. You also have a mutual fund, and it pools individual investor dollars, and then it invests them in large numbers of well-diversified securities. And you can individual investors buy shares in a mutual fund, and hopefully you're going to have a high rate of return. Brokerage firms buy and sell stocks and bonds and securities for their customers. And they do provide some other type of financial services. Some of the brokerage firms that you might be familiar with: Merrill Lynch, Charles Schwab, and Edward Jones. Most brokerage firms are part of a financial conglomerate, and it does different types of services just instead of just selling stocks and bonds. You also have an investment bank, and generally that's the underwriter that issues the new securities for corporations. They're the ones that are going to provide the money for the primary market. And finally, you have the finance company, and they're just businesses that offer short-term loans and generally very, very, very high rates. Be very, very careful with finance companies. Another term that you're going to hear when you're in the banking industry or the financial industry is hedge funds. And what a hedge fund is, it's a large pool of money that's managed and used to invest in activities that promise a high return on an investment. Now, some things you want to think about before you get out and decide you want to put your money in a hedge fund is it does require a high minimum initial investment. Generally, only the wealthy are able to be involved. They're similar to those mutual funds that we talked about, except it is very high risk, and it increases the chances of a higher return on an investment. And then that's why people will invest in a hedge fund, is because that it does give you a higher rate of return. The next couple of slides are just going to give you some terminology that you would hear in the financial industry. And the first one is the electronic funds transfer, or the EFT. Due to the advent of the computer age, wide variety of the technological innovations have made it possible to be able to move money all across the world electronically. And what that has done, it has allowed the paperless transactions for institutions to reduce the cost because of such a wide competitive battlefield within the banking and the financial industry. So when we hear the term EFT, that is just referring to the movement of funds by any means of an electronic terminal, telephone, computer, or even magnetic tape. I know most of you are familiar with the automated teller machines, which is known as an ATM, and it is the most familiar form of electronic banking. And it, of course, dispenses cash, accepts deposits, and different things like that. The next slide is talking about the ACH and then, of course, online banking. ACH is the automated clearinghouses, and we talked a little bit about those back when we were talking about the Federal Reserve, how they were in charge of this. And it's a system that permits payments such as deposits or withdrawals to be made to and from bank accounts by that magnetic computer tape. Some of the advantages of direct deposits include convenience, savings, and then potential interest earning. And then we're talking about online banking. And I know every one of you have participated in online banking. Online banking is, to me, the most wonderful thing that has been invented in the last 10 years. And everything can be done on a computer, You can use your cell phones or your iPads, different things like that, anything that's wireless. And I thought this was interesting that they say 62% of adults list the internet banking as the preferred banking method. And with the age that we're in now, I would think that that's even higher than when this book was published. Um, the rapid advances and your innovations in technology are challenging to the banking industry, and it required it to change. More and more banks, both large and small, of course, are doing your electronic access to their banking accounts. During 2007 and 2008, that financial market collapsed under the weight of declining housing prices, subprime mortgages, and those were mortgages with low quality borrowers that the government had said that we had to loan money at the time to people that really didn't qualify for them. And so what that did was it drove up the mortgages, interest rates, and then the housing industry fell, and then banks uh, were foreclosing on all these houses that they had loaned money to people that couldn't afford them. So during that time, the Fed, remember that we talked about, took some unprecedented action. And then the future banking structure was put in the hands of Congress, and they passed some reforms. They did the Dodd-Frank Wall Street reform, and they also did the Consumer Protection Act. In broad general terms, shadow banking refers to companies that perform banking functions of some sort, but they're not regulated by the banking industries that we have been talking about. Shadow banking activities are increasing. In a letter to shareholders in the 2013 annual report, Jamie Dimon, who is the CEO and chairman of J.P. Morgan Chase, he was quoted as saying to his shareholders that the bank will face tough competitors, including shadow banking. Now, in addition to shadow banks, there are peer-to-peer lenders like Prosper, which is a company that matches investors and borrowers with loans between $2,000 and $35,000. You can also get funding by internet websites such as GoFundMe, which people will go in there and try to get people to donate to fund different things that they are trying to raise money for. Health care, money, things like funeral expenses and things like that. Another similar website that's come on the horizon is Kickstart, and it funds creative projects in the world such as art, film, game, publishing, and so on. So those are some other banking industries that you want to think about. And finally, we want to talk about mobile money transfer, which is called M-PESA. Um, in large developing country, sometimes the financial infrastructure is not well supported, and many of the people in these areas, they had to travel hours by foot or train or however they could get there to get their money for everyday purchases such as food. So M-PESA was created to alleviate this problem. And what it does is it uses mobile phones, of which again, they have even become widespread in developing economies, to make money transfers. And then all that is required of the user is their national ID or passport information, and then they can send the money in a matter of minutes. You can actually do this money transfer at any bank. You can actually do it. I know in Walmart, I've seen where they do that a lot. And so someone that may be working in the U.S. would use this to send money back to their home country. So that's all I have for chapter 15. There are some discussion questions on the next slide. We will finish up with chapter 16. Again, I'm not going to hit everything in chapter 16. It's going to be just a real quick overview of that chapter. Thank you very much.